Hi, everyone. Thank you so much for joining us today. My name is Soka Yus. I'm a financial wellness counselor here with Mayo Employees Federal Credit Union. So thank you for joining us online, or if you're watching this later, thank you for watching our video, and thank you for joining us here in the audience as well. At any time you have any questions here in the audience or online, just stop me, ask some questions, then we can address it right then and there. Or if you're a little shy online or a little shy in here, you can always email me. This is my contact information. My phone number and my email address. If you cannot write this down now, you can always access it on our website at mayocreditunion.org. And my contact information will be on there as well. But I'll go ahead and have this screen up again at the end of the presentation. So today we're going to talk about different life stages in planning your financial journey and how we here at Mayo Employees Federal Credit Union can help you with every life stage that you're going through. Whether that is starting out when you're 18, or starting out when you're in your teens when you have a teen account with us, or all the way up to when you're retired or well into your retirement years. So any questions you may have, in the beginning or towards the end, we help everyone at every stage of their life. So the overviews of 5 financial life stages from 20 to 65 plus, we talk about your early career. What is it that we want you to kind of, do in your early career, how to save, things like that, establish yourself, family to mid-career, and pre-retirement, what to really prepare for, and also your retirement phase in your life. Helpful habits and goals stage by stage, tools to help you reach goals specific to each life stage. So think of this as a roadmap that combines the personal finance journey from your first job to retirement with helpful services that we have available here at MEFCU. We're focused on building financial stability, managing debt, and saving for short-term and long-term goals. Okay, so the presentation directly after this is going to be budgeting. So if you guys want to stay for that too, because even though we're going to talk about different financial goals for different life stages, every life stage involves some sort of budgeting in it. So the presentation up next is on budgeting. Think about both your age and your current financial goals to determine which stage you're in right now. Are you just starting out? Are you, 18 and you're 20 or 30, just starting your career? Or if you just have or if you switch your careers, it's okay to, you don't have to be at this age at this certain stage in your life. It's just kind of an ideal roadmap. So if you're not directly where you think where the presentation is at, is completely okay too. The primary goals in stage 1, early career, is to help build financial foundation by establishing your savings, eliminate high interest debt, develop healthy financial habits, which is really, really important, and start saving for retirement. So out of that, I would pick out develop healthy financial habits as first things to focus on, because with that healthy financial habits, it can help you budget a little bit easier too. It can help you determine your financial goals a little bit easier and help you reach those goals easier too. And also, I encourage people at any stage in their life to try to figure out what is your relationship with finances. When we talk about money, when we talk about budget, do you feel restricted? How does it evoke what kind of emotions you're dealing with? When you look at your bank statements, does it give you a negative feeling? Does it give you a positive feeling? So I encourage people to really know what is your relationship with finances. So then it helps you develop, if you need to change certain habits to help you develop healthy financial habits or not. Like I mentioned before, every stage in your life, we want you to create a budget, okay? So create a budget and build good habits. So you can use our MEFCU's checking and savings account for day-to-day expenses and to establish emergency savings. We do have, you can open up several savings accounts, several checking accounts. There's no fees for any of that. So you can open up a savings account for different financial goals that you have, that you have set up. So our checking account, excuse me, so to use our checking account to help you, determine how much money you're spending each day or each week. It helps you stay within, your budget, what you have set up. So it's really important that you take a look at your bank statement each day or whatever it is you're spending each day. And we have that available. You can access your, online banking with us 24/7. Obviously, it's free, so you can take a look at your day-to-day expenses and your spending and see what kind of expenses are coming up. You can also set up direct deposit to automate savings. So you can do this a couple of different ways, so different options too. So where you can Through your payroll, you can set it up and tell your employer that you want a certain percentage or certain amount from your paycheck to go directly to the savings account, or you can have everything deposited into your checking account, and then you can have an automatic transfer from your checking account with us to a different savings account or to a savings account with us here. So you can do it that way. The reason why we recommend automation is because it's kind of eliminating the middleman, you being the middleman yourself. Because if you see that you have to transfer things yourself, sometimes you talk yourself out of it, you know. There's a really good sale after the holidays. There's a real good sale after the holidays. You know, that bag that you've been eyeing or whatever toy you've been eyeing is now, you know, on sale, 30, 40% off. So you want to, you know, spend money on that. But, you know, you have to really focus on your financial goals and then, you know, so that way you can save for each financial goal. So that's why when you automate those savings, you're not negotiating with yourself anymore. You're not, you know, getting in the way of yourself anymore. So it's best to automate those savings. We also want you to track your income. I mean, are you getting a, you know, a 4% increase, 8% increase this year, or 12%, or what is it that, or did you get a different job and, you know, your income doubled, or did you get a different job or part-time job, and, you know, what kind of income are you bringing in at this time? At least know. When I talk to people that have a hard time, you know, that come to me and say, I make enough money, I don't know why I don't have anything left over at the end of the month. And one of my first questions when I help them set up a budget is, what is your average take-home pay per paycheck? Well, I don't know. I make this much, but I don't know how much I'm bringing in. Or they tell me, you know, I make, you know, $18 an hour, but I don't know $18, whether it's $18 or $100 an hour. If you're not keeping track of how much you're making and how much you're spending, you don't know where your money is going to. That's not always, you know, the best way to go about taking care of your finances. So always track your income, know how much you're bringing in, know how much your expenses are. Your very basic expenses, your rents, your mortgage, your light bills. We know your light bills and your energy bill is going to change according to seasons, but it's going to be due on the same day of each month. You're going to have a rough estimate of what it's going to be due. You know, things like your car payment, your car insurance, your cell phone are going to be due each month on the same day. Pretty much the same amount. So know what kind of expenses you have. Those are your fixed expenses. And then have a rough estimate or have a goal set for how much you want to spend on like groceries or going out or date nights, you know, if you have a budget for stuff like that. When I talk about budget, I don't want you to think, oh my gosh, I can't have my, you know, Starbucks every day. If you know that that's your one little thing that you want to keep in 2025, you know, to put towards your, as long as you put it towards your budget, then let it work. You know, if you have extra money to put towards the little luxuries like that to make life, you know, a little bit easier for you, by all means do so. But as long as you put in your budget, as long as what's left in the budget is going towards your financial goals, okay? We want you to set up a realistic budget, and with a realistic budget, meaning that, you know, you audit your past spending. How much did you spend on Starbucks last month or the month before? How much did you spend on gas? How much did you spend on groceries or going out and eating? Should you cut that out this year? Is that one of your goals too? And we, of course, want you to create your financial goals, okay? Without financial goals, what are we gonna do with the rest of our money? So, you know, you wanna go ahead and say, I wanna go to Italy by the end of next year or the end of this year. How much you need to save by then? We want to have our goals to have a start date and also have a due date, an ending date. Otherwise, then it's just kind of, you know, daydreaming as to when that might be. But if you set a due date, you know, I want to go by December of this year, so you have 12 months to save for it. How much you need to save each month or each paycheck to put towards that category. We want you to save ideally 15 to 20% of your income, starting small if needed. So this can be your take-home pay, your net pay, okay? I know for a lot of people out there, 15 to 20% of your income is a lot of money. Some people are, you know, I'm very proud of you, you're able to save 1% or 2%. It's just the way that the economy is right now, and there's lots of family struggling out there. Ideally, it's 15 to 20% of your income, but if you can't reach that, it's okay. Don't worry about it. You know, when you're in your early career, you're not making the most money at this time, so the goal is to always aim for that goal. But if you can't reach it, then 1, 2, 3% of your income is fine too. We want you to establish and use your credit responsibly. So use your credit card and pay it off monthly. If it's not the entire balance, then, you know, most of the balance that you spend. Ideally, you want to spend less than 10% of your available credit, or at max 30% of your available credit. So if you have a $10,000 credit limit on your credit card, maybe don't go over $3,000, that's 30%, or preferably under 10% of that, okay? So that's easier so then it shows that you have the willpower to not spend everything, and it shows the creditor that they can trust you in paying everything back and that you're able to pay things back too. So building an emergency fund, so starting building emergency fund is the goal. We want you to have about 3 to 6 months of essential expenses. So to determine how much your monthly expenses are, you add up your your fixed expenses, your variable expenses, like your mortgage and your food and things like that. How much does that come out to each month for you? Do you want to cut back on some of those expenses? And then does it come out, what is the total balance at the end of the month? Is it $3,500? Is it $4,000? So you take that total expense that you have each month and you multiply it by 3 months or 6 months. We prefer that you have 3 to 6 months of essential expenses set aside in a high yield savings account or a money market account that we have available here at MEFCU. So you can always come in and talk to member services representative to see if you can open up a money market account or a separate savings account so you can put that towards your goals. So 3 months, if your expenses are, coming out to $4,000 a month, I can see why 3 months, making it $12,000 might be a little intimidating to have as a goal. It may seem like it's very difficult to do, but you can always spread that out over a year. How much you need to save from each paycheck for the next year in order for you to reach your 3 months goal or your 6 months goal. But it's a starting point, right? So after you have those emergency expenses, you can put more of the savings towards other financial goals as well. You want to consider MEFCU's money market account for higher dividend earnings on emergency funds, allowing your money to grow while remaining accessible. You want to contribute regularly until you reach your goals. So automate your savings is the easiest way to do that. Next thing we want you to do is manage and reduce your debt. Our Visa credit card may offer lower interest rates than others, which can help you pay off balances faster. Aim to pay off the full balance each month to avoid interest. So for example, if you have a high interest rate on a credit card right now and you qualify for one of our visas that has a lower interest rate, you can do a balance transfer to transfer that large balance with a high interest rate to our credit card with a lower interest rate and saving you a lot of money, and then just make payments on that each month, or if you have the ability to pay it off too. But when you do get a credit card with us or with anyone else, we encourage that you pay off the balance every month. If not, again, we want you to pay roughly about 10 to keep your balance, bring it down to about 30% or 10% left if you are able to. Pay down high interest first, like credit cards, and make minimum payments on student loans until you're able to tackle them more aggressively. So student loans is all the hot talk right now, and it's last year and the year before. So if you're just brand new, if you're just finishing school and you have a lot of student loans, make sure that you're on the right repayment program. So if you have questions about that, you can reach out to me and I can help you on studentaid.gov to see what is the right repayments loan for you or journey for you. So if you have issues helping, if you have problems, setting up a budget, or if you don't know what your next step should be, you should work with me or another financial counselor if you feel additional accountability will be helpful. For some people, they just really need to, to check in with me every 2 weeks whenever they get paid and say, hey, am I on track? And I'm doing good, but I know I fell off track, but how do I get back on? So it's good to always have, a budget buddy or an accountability partner with that. So that's where I come into. So start saving for retirement. Open a MEFCU individual retirement account with us, or an IRA, contribute monthly. Even if it's a small amount, aim to save about 10 to 15% of your income for retirement. If your employer offers 401k or 403b with a match, prioritize contributions there first to receive 100% of the match, then contribute to your IRA or Roth IRA. Now, consider a personal loan for high interest debt consolidation. So MEFCU offers personal loans that can help consolidate high interest credit cards into a lower interest fixed payment plan, making it easier to pay down. So a lot of people, with the interest was being so high for that keeps climbing the last couple years. I know the Feds cut down interest rate a little bit last year too, but it wasn't enough to make a big dent on a lot of families. So what you can do is if you find yourself in several credit card debt where the interest is quite high, you can do a debt consolidation loan. You can get a personal loan, consolidate all your debt together, get a loan with us, get a lower interest rate, and make that one payment directly to that loan. So that way you your credit cards will have a zero balance and you'll save a lot of money in the long run, okay? Look into repayment options, especially if you qualify for income-driven plans. So that would be for if you, that would be for your student loans. Just make sure you're on the right payment plan. If interests are too high, consider refinancing once your credit score improve, or if you need to improve your credit score also. So if your interest is high with your student loans or with your credit card, work on improving your credit as well. Because remember, the higher your credit score, the lower your interest rate. So if you don't think that you know, in the last year or so, you got a new credit card. Your interest rate is high on those credit cards because your credit score isn't as high, but you've been improving in the last year. So now it's improved so much. What you can do is you can try to apply for a loan with us and see, you know, if you can get a lower interest rate and then pay off that high interest rates, you know, student loans or whatever interest loans you have or credit cards that you have. So stage 2, establishing yourself from age 30 to 40. So primary goals would be to increase your income, pay off remaining debt, excuse me, grow in your investments and start saving for long-term goals. So what does that look like for you? Continue growing your emergency fund, right? Because between age 20 and 30, between the first phase and the second phase, you must have, I mean, there's different changes now. So first phase, maybe you don't have, you know, you're still driving an old car, you don't have a new car just yet, or you haven't started a family. Second phase, chances are maybe you got into a mortgage, maybe now you have a new vehicle, maybe now you have a baby or two. So now your financial priorities change a little bit. So increase your increase your emergency fund. Maybe your emergency fund from when you were 20 years old is completely different than when you were 30 years old with a mortgage, a car payment, life insurance, and a couple kids in daycare. So determine how much your new emergency fund is going to be. So it's really good to always you know, sit down every weekend or once a month or something with your partner or with yourself or with a budget buddy just to go over, do I need to increase my emergency fund? How much is available in there? And how much more do I need to put towards savings for my emergency fund? The goal is to have at least 6 months of emergency fund if your lifestyle or income has increased. Use our MEFCU money market account for accessible savings as well. We want to accelerate debt repayment, focus on paying off remaining student loans, car loans, or other debt. Consider a personal loan from MEFCU to consider debt at a lower interest rate, like we talked about. Use our digital banking tools to track and automate debt payments. So when you have, you know, loans with us, credit cards with us, you can track all that all in one page. You can see what's available in your savings account, what's available in your money market account, in your checking account, what's available in your, you know, your credit card or car payments or mortgage and everything too. So we have all that available. Consider the debt snowball or avalanche method. So I help people get out of debt by setting up certain budgets and certain repayment plans. So if this is something that you find yourself, if this is one of your goals for 2025, by all means you can reach out to me and we can work on that together too. But the point is to try to get rid of debt as quickly as possible. And increase your retirement contribution. So ideally, we want you to start, you know, your retirement as early as possible. But, you know, like a lot of young kids, when I was in my early 20s, I was not thinking about, you know, where I was going to retire, anything about retirement. It seemed like 5, 6 lifetimes away, so I wasn't thinking about that at all. So maybe if you're in that situation, you know, you're just now finishing school, or you're able to save a little bit more, you have your 6-month emergency savings set aside, your debt's almost paid off, maybe increase your retirement contribution. You want to maximize the contribution to your employee's retirement plan and the MEFCU IRA. We want you to target 15 to 20% of income if possible, as long as you know, max out your 401k contribution, max out your Roth contribution each year according to, you know, what's available for you. If you're over 55 or 65, there's that, like some catch-up, you know, amount that you can increase and stuff. So, but it's really important that you talk to someone about that. If you're with Mayo, I know Fidelity does a really good job with talking to their members about their contributions and what you need to contribute or, you know, invest each month, each paycheck to reach your financial goals by retirement. But we also have a team here too that can help you. So just reach out and let us know what some of your financial goals are, and we can see if we can get you to a team to help you with that also. Consider a MEFCU certificate, a CD, for a secure dividend earning place to grow, especially if they're saying that, you know, interest rates are going to grow. You know, if you are, or if the market is going to be volatile, so a safe way to another savings method will be to get a CD with us. It's going to be a fixed interest rate for 10 months, 11 months. We have, teen certificates, and we have regular CDs as well. So start saving for major life goals. Open a separate MEFGU savings account for goals like a home down payment or a child's college fund with a 529B plan. So we have that available here too. If you have any questions about that, just talk to one of us, and then we'll be able to go ahead and get you set up on that. For college savings, our money market account certificates offer dividend growth without the unpredictability of other investments. So it's always a safe bet to go. So, but stage 3, family and mid-career, 40s and 40 to 50 years old. Your primary goals: maximize your savings, pay down remaining debt, and grow your investment. Pretty much the same, but we're going to go accelerate it a little bit here. So you want to boost your retirement savings as much as possible. Take advantage of the MEFGU IRA accounts and CDs for stable dividend earning retirement funds. We want you to aim to increase contribution to retirement accounts annually as well. So this can be with your current job or any other retirement accounts that you have. If possible, max out your 401k, 403b, your Roth IRA, and IRA contributions. Consider catch-up contributions once you reach the age of 50. So that's something, if you don't know what that is or you have a hard time trying to figure that out, by all means talk to one of us, and then we can get you over to a team that can help you with that. Or you can talk to Fidelity as well if you're with Mayo. So regularly rebalance your investments and focus on diversified portfolio aligned with your risk tolerance. When you're a little bit younger, you have the ability to be a little bit riskier with your investments. But when you're closer to retirement age, you want to be a little bit more conservative as well. So again, the goal here is to pay down debt as quickly as possible, especially if it's high interest rate debt. You want to go ahead and get rid of that as quickly as possible. We want you to maximize your savings. Now that you may have your 6-month savings set aside, what other saving goals do you have? Do you want to contribute that, put that in a high yield savings account and a money market account with us here? So it's something, every stages have different life goals. We want you to really focus on those financial goals according to your life goals. So Save for Kids College Fund, again, MEFGU's money market or CDs can serve as college fund, providing interest growth with low risk. You can open a 529 college savings plan with us. You can set up recurring deposit from into these accounts and build up college funds over time. So you don't even have to think about how much you need to transfer over. Just set up an automated transfer from your savings account or checking account to these other investment account. You don't have to think about it. Set up recurring deposits, like I mentioned. Evaluate options like scholarships and financial aid, and have family discussions about funding college. It's okay to be transparent with your kids, about what you can afford with college and what you cannot afford with college. I think it's really important when I work with family in the family dynamic that the kids do see that this is how much money mom, dad's bringing. This is how much is going out too. So be transparent with that so they can learn how to be responsible with their money the right way. That way they can learn with you. So that when the best time to do that is when you're talking about paying for college. How much do they need to get for scholarships and financial aid, and how much can you contribute? How much do you have set aside for their college fund and stuff? So the Minnesota Credit Union Foundation Scholarship, the applications is something that we have available here at the credit union. Applications are typically due in November. So if you have questions about the scholarships, you can go to our website, and we should have that available up there too. But there's a lot of different scholarships that you can look into also. So this is a great time to really talk about your teens, about building healthy habits with finances. You want to pay off your mortgage and other remaining debt. So that's the goal, right? So you have the ability to do that. But you want to aim to reduce and eliminate mortgage debt and any remaining student loans or personal loans. So if you need extra funds, a MEFGU personal loan can help with manageable terms and rates. Avoid any new debt except for strategic purchases that fit your budget and financial goals. When we talk about strategic purchases, we're talking about, buying, this new house. Is it going to be something that's bringing you extra income, or is it something that's really going to help your family out? How strategic is it? Do you have a strategy to pay it off as quickly as possible? Or, if you need to get a personal loan to pay off this high interest rate, credit cards, is that something that is part of your debt payoff strategy, or are you just getting a personal loan just to spend it on vacation or something? So have a strategy on how to get out of those debt. Increase your insurance and estate planning. It's really important that, if you are, we're talking about homeowners insurance, and we know that that increases every year, and this year is, no exception. So we're talking about homeowners insurance, your car insurance, your life insurance, your medical insurance. Those are a lot of things to review at the beginning of the year and also at the end of the year as well, and mid-year, of course. Do you have enough insurance to cover all of that? If something happens to you, will your family be covered? And if they are, how long will they be covered? Are they going to be okay? Do they have to move out of the house? Do you have to sell the house? Do you have enough life insurance to cover all of that? It's not a fun topic to think about, but it's absolutely necessary, right? So we don't want to leave our kids or, remaining or family members have to struggle to figure out how to do that when you're not here. So it's really important that you do estate planning that ensures adequate life and disability insurance to protect your family's future. Update your estate plans and beneficiaries, especially on your MEFCU accounts and retirement accounts. So I encourage everyone to just do an overhaul of all the accounts that you have. It'll be your retirement accounts, your check-in savings, personal loans, 529 plan, whatever financial accounts you have it all in one section, have it all in one portfolio or actual folder. So in case anything happens, your family has direct access to see, what is the username, password, who is the beneficiary, or do you need to, do they need to reach out to an attorney for your will and trust, or that's part of estate planning. So it's really, really important to do that in this stage or in the stage. Pretty much any stage of your life, but especially during this stage, because you generally have a little bit more to lose at this time, at this stage of your life. So we want you to update the beneficiary just to make sure that, if something happens to you here, does your spouse have access to your checking accounts to make sure that they can pay the bills before the life insurance comes in and stuff? So we deal with that quite often too. We want you to reevaluate your emergency fund to align your current lifestyle. Did you buy a new vehicle? Is there a boat in the picture? And do you need to increase your emergency fund and stuff? How much do you have available in your emergency fund? So it's really important to reevaluate that. Step 4, pre-retirement, 50 to 65. So we want you to maximize your retirement funds, preserve wealth, and prepare for a smooth transition to retirement. You want to max out your retirement contributions, take full advantage of catch-up contributions for retirement accounts through MEFCU IRAs and other retirement savings options as well. I want you to reevaluate your retirement income sources. How much are you getting for Social Security? Have you met the threshold? Do you know what the threshold is? Are you retiring at 64? Are you retiring at 67 and a half? Or when are you going to be eligible? What kind of pensions are you going to be receiving? Or if you are receiving anything, what about your investments? How much is that going to hold you over? So when you have all those income together, is it going to be enough to live off on when you retire? Do you want to work until you're 70, or what is your retirement? What is your ideal retirement lifestyle like? We want you to adjust your savings and investment risk as needed. Okay, so it's really important that you talk to a financial planner or an investment team about that in order for you to reach your long-term retirement plans. Want you to reduce your investment risk. Of course, you want to shift to more conservative investments in your MEFCU IRA and money market accounts to preserve your capital. We want to balance growth investments with safer and diversified assets for secure growth options that reduce exposure to market risk. If you talk to anyone about when you're in this age range, that's what mainly they're going to talk to you about, to preserve the risk. Plan for healthcare expenses. What does that look like for you? How much is nursing homes, or did you know that if you if you're in a nursing home and you own your house too, but if you pass away, you don't have enough in your if you still have a bill with your nursing home, the nursing home can take the profit up from your house, or can put a lien on your home, so that way their debt can be paid too. That's something to really talk to an attorney about too. How can you protect your assets for your kids from situations like that? Consider long-term care insurance and dedicated savings account to cover medical expenses in retirement. Long-term care, again, how much is that going to cost? Short-term care, do you need to go to rehab for a few months? How much is that going to cost you? What kind of insurance do you need to cover that? Something to really talk to someone about too. Review your Medicare and any supplemental insurance plan to understand future coverage and costs. So, there's so many different Medicare options too. Is it going to cover your eyes? Is it going to cover certain medications? You need to get different Medicare coverage to get certain medications covered too. It's a lot to go over. So really prepare yourself for what's coming up for your retirement. So that way your kids doesn't have to make those decisions for you. So pay off remaining debt, of course. We want you to do that as quickly as possible. Target any remaining debt with the goal of being debt-free by retirement. Use MEFCU's personal loans or debt management services for assistance if needed. We want you to review your estate planning and beneficiary, update estate documents, including wills and beneficiary designations on MEFCU accounts, set up or update your will, healthcare directives, and power of attorney. So it's really important for that. So remember, if you're no longer here, power of attorney is no longer, valid. So just be sure that you have your estate planning set up. Who's going to take care of everything, your finances, when you're no longer here. Consider establishing a trust if needed, and regularly review your beneficiary designations. So again, not fun things to talk about, but it's absolutely necessary. Stage 5, retirement, 65 plus. Primary goal, sustain retirement income, manage expenses, and enjoy financial security. Set a retirement budget, so track your retirement income sources. Is it going to be from Social Security, your retirement accounts, your investments? Where's it all going to be from? Are you going to be working part-time for a little bit? How does that affect your insurance moving forward? How does that affect anything? Given your health, did you want to still live here in Minnesota? Do you want to move to Florida or somewhere warmer? How is that going to affect your budget and your expenses moving forward? But whether you decide to stay here in Minnesota or move to California or New York, once you're a member with MEFCU, you're always going to be a member with MEFCU. So we can always help you out, and you'll always still have access to your account by going to the digital, using our digital banking tools to help you monitor expenses and remain and stay on budget. So plan withdrawals from retirement accounts strategically to minimize taxes and maintain income. That's something for you to talk to your financial planner about too. Consider delaying Social Security benefits to maximum monthly payouts. Do you want to just retire at 64 or 65 and get the least amount available, or do you want to work just a little bit longer, 2-3 years, and retire and get your maximum retirement, your Social Security? Something to really look into. So you want to manage withdrawal strategy. Establish tax-efficient withdrawal strategy for your MEFCU IRAs and other retirement accounts. Keep a portion of assets invested for potential growth, but maintain a conservative allocation. Revisit your portfolio regularly to ensure it aligns with changing needs. So that's something that's really, really important that you talk to your investment partner about. Let them know, what, I need extra money at certain quarters in my life. The fourth quarter of each year, it's going to be Christmas, so I need extra money. Do I have enough available in there to withdraw what I need, or where do I need to move my money around? Do I need to be a little bit more riskier with a certain amount, or a little bit more conservative? We want you to preserve your emergency fund and healthcare savings. So keep a substantial emergency fund in your MEFCU money market account to cover unexpected retirement expenses. You just don't know what comes up here. So hopefully just make sure you have enough in there to cover, your deductibles, or if you, to cover your insurance payments if you don't already have insurance with Mayo or Medicare. Maintain separate savings for healthcare costs to protect your retirement budget. That's really important too. Stay on top of healthcare expenses, including premiums and out-of-pocket costs. Know what your out-of-pocket max is. Know what some of your medication costs. Your teeth or dental care. How much does that cost? Your eyes. How much does that cost? Reassess your lifestyle and budget as you transition fully into retirement. So it's really fun and exciting to look into retirement, but it's also kind of really scary financially too. Do you have enough? What else? You're pretty much planning what can go wrong in your life, and you want to have that much money available to secure it, to make you feel secure enough to live, comfortably. We want you to optimize your estate and legacy planning too. Finalize any updates to estate planning such as wills, trusts, and beneficiary designations. Discuss legacy planning with your family to ensure your wishes are known and respected. So again, not very fun to talk about, but it's necessary. But most importantly, we want you to enjoy your retirement, right? Whether you're meandering around in a bicycle in Hawaii, or you're traveling, you're living out your dreams and remodeling a house in Italy, or you want to live here in Minnesota and bear the cold winters with us. We want you to enjoy your retirement wherever you're at, but we want you to be financially secure as well. We want you to focus on whatever it is you love: travel, hobbies, family time, and other goals that you've worked towards. So MEFCU's digital banking member services will always continue to support your financial well-being throughout your retirement. Again, once you're a member with us, you're always going to be a member. So we're always going to be here for you to help you with whatever financial needs. So additional tools and supports that we have, you can meet with me virtually or in person for ideas on how to better plan ahead for your future expenses and to set up detailed budgets. Use tracking tools to manage expenses. You can email me for a template if that's what you need. There's a lot of really good apps out there too, lots of really good templates out there too, but I have a very basic Excel spreadsheet that I can send out to you too if you need that. You can set up free appointments with our investment team at MEFCU. They can definitely help you answer some really hard questions too and kind of give you an idea what you should do moving forward. You want to keep tabs on your expenses with services MEFCU offers. We have online and mobile banking, e-statements, automatic savings transfers, and bill pay. So take advantage of those if possible. So again, my name is Soka Yus. I'm a financial wellness counselor here. This is my phone number, my email address. If you can't write this down now, you can contact me, reach out to me on our website. So my email will be on there as well. Okay. Do we have any questions at this time? No questions? Perfect. Well, thank you so much for joining us today. I hope you stick. Yeah.
Roth conversion, like right after you're retired, I think the income will be lower. At that point, maybe it's good to convert some pre-tax contribution to Roth.
I think that's a great question for the investment team. So I'm not able to answer any of the investment questions, but I really think that if we can get you connected to someone in the investment team, they can definitely walk you through that and see what is the best option for that. Would you, I mean, I can meet with you afterwards and see if we can get you set up with someone. Is that okay? Yeah, absolutely. Yeah, okay. Yeah, that's a great question. All right, well, thank you so much, everyone, for your time today. Oh, yeah? Uh-huh. Uh-huh.
So the question is, how much of our savings should we put into our personal investing accounts that are not 403B? I don't know if it's going to be the same answer as you can't really talk about that, but yeah.
Yeah, absolutely. So I think it's a great idea at any stage of your life that you sit down with an investment partner, whether it's Fidelity or someone that's with us here that we partner with. So that way they can answer those questions for you. You know, if you can put anything at all towards a separate investment account, that's ideal too. So if you're able to put, you know, anything more than 1%, that's also wonderful. But I really think in order for you to get a better answer, I think it's a good idea to sit down with someone, with our investment partner, to see what kind of lifestyle you want. What is it that you're trying to reach with that kind of financial goals, you know, so that way they can help you determine the exact number and the exact percentage. So that's kind of an answer, not answer.